of the conference, so hopefully everybody's been having a great experience. I guess I should take this off. So this panel is actually one of the panels I always look forward to every year, except the main difference is usually I'm over there relaxing and Steve Brown is over here moderating. So when Raf asked me to moderate this panel, my first thought was like, boy, I hope I don't mess this up. So, but we do have a really great collection of experts. I'm pretty much going to be riding their coattails. First, we have Frank Nothaft. So he is Senior Vice President and Senior Economist at CoreLogic, where he oversees research for real estate finance and the housing market. He also previously held the Vice President and Chief Economist post for Freddie Mac, and was also an economist with the Board of Governors for the Federal Reserve System. And then up next, we have Lawrence Yun, who is the Chief Economist and Senior Vice President of Research for the National Association of Realtors. A lot of you probably get his forecasts every month on your emails. I know I do. And so in addition to directing research activity and creating forecasts for the National Association of Realtors, he is also part of several economic forecasting panels, such as the Harvard University Industrial Economic Council. And then last but not least, we have John Worth, who is the Executive Vice President of Research and Outreach for the National Association of Real Estate Investment Trusts. And so prior to joining the association, he founded the Office of the Chief Economist at the National Credit Union Administration. And John was also involved in the housing and financial crisis response as Director of the Office of Microeconomic Analysis for the US Treasury, where he worked for nearly a decade. So these guys are going to be doing our forecast, and we're going to start with Frank from CoreLogic. So here you go.
Thank you so much, Jason. It's truly a pleasure to be here and see all of you in person this year. It's been such a trying period, I know, for so many of us since the pandemic began. And while we've had video technology that has helped us stay connected over the intervening period, it's really not the same thing as meeting in person. So it's truly good to see everybody here once again. I'm going to cover our projection for 2022 as soon as the slides come up. There are 5 points I want to make regarding the outlook for the economy and specifically for the housing market in the next year. And I'll cover each one of these in detail. In terms of mortgage interest rates, we do expect them to rise gradually over the course of the next year, but still remain historically at very low levels. So mortgage rates up a little bit, but still historically low. Second, we expect to see home sales rise a little bit more relative to the 2021 volume, putting the total number of home sales, both existing and new, at the highest level in 16 years. Third, as you know, we've had really robust double-digit home price and single-family rent growth over the last year. We expect that to moderate, and moderate significantly over the course of the next year. I don't see how we can maintain double-digit home price and rent growth year after year. And in our projection, we have some moderation of demand, some increase in supply, moderating home price growth going forward. Fourth, we expect to see purchase money originations strengthen, but refi originations decline by about $1 trillion. That's a big number, $1 trillion. But when you put it in the context of the size and volume of originations in the United States, it's a drop. It is a drop, but it's a drop of about 25% in dollar originations. We're estimating roughly $4 trillion in home mortgage originations in 2021, declining to about $3 trillion in home mortgage originations in 2022. And all that decline is in refi. But what I find really interesting is that the mix, the composition of refi originations will change in the coming year compared to what we've seen in the last couple of years. And finally, I'll share some thoughts about what we expect to see with delinquency rates and distressed sales. As you know, foreclosure rates, because of the foreclosure moratorium, are at a generational low. right now. I do expect to see an uptick in foreclosures, an uptick in distressed sales, but only an uptick. It's not going to be a groundswell or a flood of foreclosures, not like what we saw back in 2006, 7, and 8. Nothing at all like that. A bit of an uptick, and overall, delinquency rates will continue to remain quite low given the strength in the economy. So those are the 5 points for our outlook for next year. So let's take each one of them in turn. So mortgage rates, we do expect them to rise gradually, but still remain historically low. So we have a projection where mortgage rates rise approximately 30 to 40 basis points, 0.3 to 0.4 of a percentage point over the course of the next year. It doesn't happen immediately, it doesn't happen on January 1. It's a gradual process. The average rate that we are projecting for 30-year fixed-rate mortgage rates, about 3.4% next year. And you can see, even though that's higher than what we've seen in the last couple of years, it's really still quite low historically. When we look at the decade prior to the pandemic, we're still expecting mortgage rates next year to be well below the decade average pre-pandemic. So continuation of historically low mortgage rates, albeit a bit higher than what we have seen in the last couple of years. Turning to home sales, we are expecting home sales to rise a little bit further in 2022, putting the total number of home sales nationwide at close to 7 million homes, the highest number since 2006, the highest in 16 years. Now, turning to home prices and rent, we are expecting a moderation in home price growth. So just this past Tuesday, we released the CoreLogic Home Price Index for the month, through the month of October. We reported an 18% rise in home prices in our national index. That was the largest 12-month growth in our national index in the 45-year history of the CoreLogic Home Price Index. So we're seeing not just double-digit home price growth, but record growth, record annual growth in home prices. We are expecting that to moderate. Now here in the chart, I said 18%. This chart shows 15% because it's the average over the course of 2021. So when you average it over the 12 months of 2021, it's not 18%, it's about 15% rise in home prices. But our latest report we put out on Tuesday shows 18% over the 12 months from October 2020 to October 2021, with home price growth exceptionally strong in lots of the country. Now, we are expecting moderation in price growth. We're expecting prices to rise on average about 7% over calendar year 2022 relative to calendar year 2021. The 12-month projection from October 2021 to October 2022 is about 3%, and that's what's in the press release we put out on Tuesday. So again, annual average rise about 7% in 2022 with some further moderation in 2023. Why do we expect a moderation in price growth? We expect a moderation in price growth from two forces. First, we expect a moderation in home buyer demand as we see an erosion of buyer affordability going forward. An erosion of buyer affordability because home prices are going up and because we see mortgage rates gradually rising. Mortgage rates still remain low, but they will be a little bit higher than what they have been. And between prices up, mortgage rates up, eroding affordability, at the margin, we'll see some moderation in overall buyer demand. Secondly, we're expecting to see more inventory on the market in the coming year. More supply. As you know, inventory has been extraordinarily lean, extraordinarily in short supply for much of the last year or two. We are expecting more inventory to come on the market, especially as we get into the spring. That additional inventory comes from three different sources. I do expect we'll see an increase in single-family starts, so more new home supply. We also expect to see some existing homeowners who've been sitting on the sidelines because of the pandemic. They had intended or planned to sell their home at some point last year or the year before, but then the pandemic hit, and they decided to take a time out and wait until the pandemic was passed, wait until they were vaccinated, wait until they got their booster shot, whatever it may be. And I think we're going to see some of that supply come onto the market in the spring. Third, I do think there will be some borrowers who are at the end of the 18 months of forbearance who are going to continue to have some challenges in remaining current on their mortgages. Again, just a small uptick in distressed sales, but still an uptick in distressed sales, adding to inventory, adding to supply. So between those two forces, we expect a moderation in price growth. And I want to emphasize that previous slide was about the national picture. Again, it'll vary a whole lot by market. It's not uniform across the U.S. in terms of home price growth. And what I've shown here is how our house price forecast for 2022 varies by state. I picked the 5 states where we're forecasting the strongest growth, 5 states with the slowest growth. So again, not uniform. It's not 7% house price growth annual average in 2022 everywhere. It's going to vary. Where we see some of the stronger home price growth is in some of the southern states. And likewise, it varies around the country. I want to mention also single-family rent growth. Single-family rents in the CoreLogic single-family rent index, they're cooking really good. We've got low vacancy rates on single-family rental homes. They're in strong demand, and we're measuring double-digit rent growth on single-family rental homes in our latest monthly index. Partly that's reflecting household choices, family choices among families who are tenants, who are renting. In some sense, their preferences for housing and housing structure is no different than those people who are prospective home buyers. During the course of the pandemic, many of the families who are tenants who rent, they are looking for more space as well for their office from home. And so we've seen, especially in the first year of the pandemic, a move out of some of the high-rise rental apartments and into single-family homes, especially single-family detached homes. On average, a single-family detached rental home has twice as much square foot of living space as a multifamily rental apartment. And during the pandemic, that additional interior space, as well as the social distancing with neighbors you get with a single-family house, has been in strong demand, not just for prospective home buyers, but for tenants as well. Looking at the single-family rent growth, again, not uniform across the country. It varies a lot by market. And I've shown what we've seen over the past 12 months and the past 24 months for rent growth in a number of big markets. My fourth point is about originations. We expect purchase money originations to be higher next year because we're expecting more home sales, and we expect home prices to be higher. So purchase money dollar originations are up. However, refi originations we expect to be down roughly $1 trillion over the next year. So down about, within refinance, about 50% from what they have been here in 2021. But the composition of refinance, the mix of product within the refinance origination space will alter as well going forward. We expect much higher cash out component. And what I've plotted here in this chart is the cash out percent of refinance originations over time. And as you see, even toward the end of 2021, we've begun to see a pickup in the cash out share. We expect that to continue in 2022. So overall, a smaller refinance origination market, a shift toward cash out in the mix of lending. And also, we're expecting on average, the credit score of refi borrowers to be a little bit lower on average in 2022 compared to 2021. And we expect the average loan term to be a little longer than it has been. During the refi boom of the last couple of years, a lot of borrowers refinanced into 15-year fixed rate product. Looking into 2022, it's not a rate and term market, it's more of a cash out refinance market. The typical cash out borrower will be taking a 30-year term. So on average, the term on refinance loans a little bit longer in 2022 compared to 2021. I'll mention too that this morning at CoreLogic we put out our quarterly home equity report. We found with the really rapid growth of home prices, that has driven up home equity wealth nationwide. What we found was a record increase in the amount of home equity that the average homeowner has in the U.S. and a record increase over the last 12 months from September 2020 to September 2021. The increase on average nationwide was $56,700 per homeowner. Big time increase. That provides some of that equity breathing room in order to apply for a cash out refinance loan in the coming year. My fifth and final point is just about loan performance. So what I've plotted here is in red is a serious delinquency rate. That's a percent of loans that are 90 days delinquent or in foreclosure. The blue curve is a component, the blue curve is 30 to 89 days delinquent, so that's 1 or 2 months delinquent. If you add the two curves together, you get the total past due, 30 days or more, if you add the two together. So what we saw when the pandemic hit was a big spike in delinquency, 1 month, 2 month delinquency rates. That occurred in April and May of 2020. That's a big spike in the blue curve. It then transitioned into serious delinquency rates. The good news is both have come lower. In fact, for the 1 month, 2 months, the 30 to 89 delinquency rate, it's the lowest we've ever seen. It's the lowest in a generation. Our data goes back more than 20 years. It's the lowest that we've seen in a generation for the 30 to 89 day delinquency rate. Serious delinquency rates, not at an all-time low. They are trending lower, and that's good. But what we've also looked at is the percent of those loans that are seriously delinquent that have a large number of missed payments. So in this chart, we look at the percent of loans, of borrowers, who are 6 months or more delinquent. That is, they've missed at least 6 monthly payments. And you can see that's coming down too, but it's extraordinarily high, especially much higher than it was pre-pandemic. A lot of these borrowers are people who've been in the CARES Act forbearance programs, and they're beginning to come to the end of their 18 months of forbearance and are exiting from forbearance. Many of those borrowers will maybe get a loan modification and be set back on a course where they can be current on their loans. And that's what we expect. We expect most borrowers who come out of forbearance will be successful, will be able to remain current. But not everyone, sadly. Unfortunately, we are expecting that there will be a certain number of borrowers who continue to be in extraordinary financial distress for a variety of reasons and will not be able to remain current even once they exit from forbearance and are offered a loan modification. That's why looking forward, we expect to see an uptick, not a flood, an uptick in distressed sales in 2022. Of the borrowers who are in forbearance programs, we've done an estimate at CoreLogic where we've estimated that about 1% of those borrowers have negative equity, 1 to 2% have negative equity. Those are the ones who are most at risk to go through a distressed sale at some point in the course of the next year. So let me stop there and turn it over to Lawrence.
Great, Frank, and many of my thoughts are very similar, recalling about imagining the unimaginable, or maybe something that we cannot really imagine. Certainly the COVID has introduced this environment, and who knew that housing market would take off partly because of COVID, wanting to be away from big cities, or people can be away from big city with many office workers now having that flexibility. I think we are only in the first inning of this transition about what does work from home or returning to office really means. I don't think people really know. I don't think people know about the labor force, whether the young people will quit their job if it requires coming back to office half of the time. They said, that's way too much. I want to be even more flexible. So we really don't know. I think the senior management team do not know. I think there's generational difference. Of course, the CEOs are generally older. Younger workers are much more willing to accept. So I think, with this unimaginable aspect of the pandemic and boosting the housing demand. The other part is here in Miami. I recall back in 2010, 2012 period, front page, I think it was a Sunday issue. Back then, the paper issue, not the online issue. Paper issue was still relevant. So, Sunday paper, Miami Herald, coming out to say 40 years of housing supply in Miami. And one of my realtor friends said, oh no, I'm going to be dead by then. Because the person was wanting to see some return to home prices, and with 40-year supply, they were not going to see that anything in their horizon. But of course, it was chipped away even before the pandemic. How there was a steadily building of housing shortage before the pandemic, and then shortage simply exacerbated. So let me go to the chart. First, regarding the overall employment. The unemployment rate looks to be back to normal. The latest number, I think, is like 4.2% unemployment rate. Economic textbook will say, oh, that's pretty good. That's a normal, good functioning economy. But this chart shows that we are not back to normal if we count people who have jobs. Rather than trying to count unemployed, let's count the people who have jobs. And we are about 4 million short. This is over almost 2-year time span. Over a 2-year time span, in an expanding economy, we would have about 4 million job creation over 2 years. So you may even actually say that we are short by actually 8 million jobs compared to what we could be in a normal expanding economy. So we are not back to normal in terms of the overall job market situation. And there is an interesting state-by-state variation. And I think maybe you are getting to read more or that some states that are much more looser or relaxing of the restriction about what businesses can open, how much of a restriction and so forth, that they are generally functioning better economically at the cost of more risk related to health and COVID. So that's a big trade-off that one sees. So the orange colored states are the states that are fairly loose in terms of what businesses can do. There's not a severe lockdown, or they reopen the economy much sooner. So Idaho, Utah, Arizona, and Texas are the only 4 states with more jobs today compared to March 2020, when the ugly virus came to the country. In the darker shaded areas are where there is a larger job decline. So among the big states, the New York State is down 7.2%, and then you see some of the oil-producing states of Alaska, Louisiana, Wyoming are also down more heavily compared to other states. In the southern states like Florida, Georgia, they're almost ready to turn positive. In a month or two, they should be turning positive compared to pre-COVID conditions. So some variation related to the employment condition. Regarding home sales, Frank showed you the data that is going to be a 16-year high on an annual figure, but on a month-to-month, this is showing pre-pandemic sales activity, the first half of the graph, and the post-pandemic home sales activity, with right in the middle, the disruption from the lockdown. So pre-pandemic, in hindsight, it was very boring. A little increase here, a little decrease here, nothing exciting about it in hindsight. Then sales plunged during the lockdown. Then when it reopened, consumers were eyeballing record low mortgage rates, the massive expansionary monetary policy, and the pandemic itself of people wanting to have larger space or not needing to go to the office. So single-family home sales really boom, surge. Then things began to peter off. This sort of a little softening in the sales, but now we are beginning to see a mini surge. This data is seasonally adjusted annualized. So with every economic data, whether job numbers is seasonally adjusted, which means this does not mean that winter home sales are better than other part. It just means that winter of this year looks to be one of the best winter home sales activity in many, many years. In fact, it would be the second best in 16 years. Only last year would have been better in terms of home sales. So the momentum looks very good, and in a sense, you may even say the momentum looks like a sort of second mini surge that appears to be developing. Annual sales, this is what Frank mentioned. So we also believe that it's going to be the best in 16 years. But next year forecast in 2022, sales getting shaved a bit, a little lighter. Nothing alarming, but that's due to the rising anticipated mortgage rates and increased supply. With increased supply, there's less less pressure on the prices to rise, but the sales decline is principally coming from the increase in mortgage rates. Now, looking at the home prices. So top line is the median home prices, again, hitting all-time high, strongest price appreciation that we have ever seen in a recorded data, whether NAR data, the repeat price measurements, the strongest price appreciation. So naturally, the consumers will be asking, and the reporters validly should be asking the question, are we in a bubble, knowing that 15 years ago, Americans suffer from it? We don't want to have a repeat. Suffering for the country is not a good thing. So it's a very valid question. And the bottom graph shows the price to income ratio, median home price over median income. And it looks like we are back to 2005. And of course, 2005, it was the peak, then once we had the decline. But aside from just purely data, not knowing the sort of the backdrop, the real world is we don't have subprime lending, we don't have overbuilding. Home builders were building over 2 million homes back in 2005. So without knowing that, just on this graph, it looks like, well, it could be a repeat of 2005. But another way to show is that most people who buy a home, or the risk assessed, the systemic risk to the financial market is really about mortgages, not about all cash purchase. All cash purchase, there is no systemic risk. It's just the homeowners will see some price decline, but it doesn't cause any chain reaction to the financial system. So it's really about the mortgages, and given the historically low mortgage rates, the mortgage payment in relation to the median income at the current prevailing mortgage rates appears very manageable. But it will be rising because mortgage rate will be rising, and hence it's going to cut into affordability. So I would say my concern as a chief economist for NAR is really about what's going to happen to the first-time buyers. Can they reach the market, or are they going to be essentially priced out of the market, and we have a home ownership rate no longer rising or stuck or even declining, and then you have a situation where home prices are rising, even though home ownership is not rising, then you have a divided society between haves and have-nots. Haves, homeowners enjoying the equity gains, have-nots, the renters paying higher rents, and they dream of ownership is just out of touch given the affordability challenges. Some hot markets in the latest, Austin, Texas, I think everyone knows. Other side of Florida from here, Naples, super hot. Boise City, super hot. Osceola, north of Orlando. Maybe some people are getting priced out of Orlando, so they're going over to Osceola. Salt Lake City, Phoenix. So all the areas where the job growth has been reasonably stronger compared to the rest of the country. So again, job market certainly making an impact on the part. And graphically, time series, the top line is Austin, and let me see what it is. The green line is Charlotte, and the blue is Albany. Albany has had a stagnant job growth situation, so what one can say is that in Albany, New York, home prices compared to Charlotte 20 years ago were identical. But now Albany is about 250,000, while Charlotte is surpassing 300,000. So over time, things change in terms of their alignment. Certainly, Austin has clearly taken off. Mortgage rate forecast rising quickly, just tapering, along with some short-term interest rate hike by the Federal Reserve. And the inventory, as we know, is still down, low. Not enough inventory, but I do anticipate higher inventory in 2022. First is that just the momentum. We are still down on inventory, but with each passing month, decline appears to be less, which means just people who are just into the numbers, they say, well, the momentum suggests maybe the line will reach 0 and then turn positive. But the reality, the real world factors are home builders want to build more. There's some supply chain disruptions, the doorknobs stuck out in the container ships and so forth. But those will dissipate, and then home builders will really ramp up production. There's a strong profit motive for the builders. The other factor is about the ending of the mortgage forbearance program. A little different way to show what Frank showed is that the delinquency rate has been high, but the foreclosure rate at historic low because of the forbearance program, but that's winding down. So some people will have to sell their home, and that will be another source of inventory. And the other source of inventory is simply this: the ugly COVID that has caused toll to Americas, with many elderly really passing away from COVID. So we have seen a sharp rise in the number of the death certificate that is issued, according to the National Health Statistics. And this means that some people are mishoused. If it's both, say grandmother, grandfather has passed away, well, it's an estate sale home, and that will come to the market. A person becomes a widow, well, maybe they're in a too big a house and they want to downsize. So just the fact of these changes, I don't want to sound callous to say, during the terrible tragedy, we have more inventory, more business opportunity, but I'm just relaying the reality that we have suffered greatly in the country in terms of the human toll, and it will lead to people needing adjustment related to their housing needs. So this will also boost some inventory. So inflation is on the minds of many, and I say to the realtors, one of the things that you may want to share with your potential clients is the following chart. Some people want to buy gold as an inflation hedge. Other people may want to buy cryptocurrency. Well, show at least historically, real estate has held value with inflation. So if we look at decade by decade, 1970s, we know it's high inflationary period with 7.1% increase in CPI a year on average, 1970s, home prices did better. 1980s, interest rates shot up. Paul Volcker said he's going to kill the inflation with high interest rate. But at least early years of the 1980s, we still had high inflation. So home sales greatly plunged in the 1980s with high interest rates, but not home prices. Home prices actually grew in the 1980s because the rents were rising. Rents generally follow the consumer price inflation. So because of rising rent, home prices were still rising, even as home sales were plunging. In the other decades, you can see that home prices pretty much were either slightly better or essentially kept in line with consumer price inflation. Of course, as any stock market analyst would say, future performance is not based on past performance, so one has to always qualify qualify that, but at least this is showing that in the past, real estate has shown to be a good hedge against inflation. And this is my final chart, maybe a little hard to see. My forecast is that the unit sales in 2021, once we tally up all the data, will have shown 6.4% growth. Prices, one of the strongest ever, 14.7% growth on an annual basis. So from, say, large brokerage, realtor brokerage point of view, it will be a combination of sales and prices, so they saw about 21% revenue growth. Next year, sales coming down. I have price increasing only by 2.8%. I shouldn't even put a decimal point, 2 to 4% range in terms of prices. Why? Well, increased supply, shaving off of a demand, but one other factor, the median price that we measure is somewhat distorted. We have had large increases in upper end market, but the lower end market we also begin to come around, so that's a little distortion in the mix of home sales. We are also lessen some of the growth in the median home price. So thank you for listening, and now I'm going to turn it over to Mr. John Ward.
Thanks, Lawrence. Thanks to the sponsors and organizers for having me here. And I just want to start with a quick note, which is that if you forget everything else I say today, which, as both our press team, my boss, and my family say, that frequently happens. So it's very helpful to put that. The one main takeaway I want you to consider is that REITs, real estate investment trusts, are a great way in real time, as you're doing reporting on commercial real estate, to understand what is going on in a sector or market. So today, REITs are about 1.5 trillion in market capitalization. They own between 10 and 20% of commercial real estate in the United States, and about 145 million Americans have REITs in their portfolios, primarily in target date funds, in their 401ks and IRAs. So they're a really important part of the investment universe, and they're the primary way the broad base of Americans are actually getting commercial real estate into their portfolios. So just my commercial for think about REITs when you're thinking about commercial real estate, because they allow you real-time active view into the market. So what am I going to talk about today? I'm going to give you some highlights from our 2022 outlook, which actually just came out this morning. And I'm going to try in the next 10 minutes or so to give a little bit of insight into some of our key questions for 2022 through the performance of REITs. And those key questions are office, return to work, work from home, what's the future of office going to be, retail, what's the role of online shopping versus brick and mortar, and then I think the digitization of the world in general, how is that impacting commercial real estate, and then we'll talk a little bit about inflation and commercial real estate performance and the role of REITs, as well as some of the changes we've seen in the real estate environment. So let me just start by talking a little bit about REIT performance in 2021, and REIT performance has been quite good. I'm showing the results through the end of November. REITs at the end of November were up just about 29%. Today, we've actually had a good first week of December, so REITs are up about 33-34% for the year, depending on where they opened this morning. It's been a very strong recovery for REITs. And of course, that followed on a tough year in 2020, where REITs were down about a little more than 5% for the year. So I think it's important when we think about REIT returns to understand, to really take a look at, and I'm going to just jump past this and take a look at REIT returns over the entirety of the pandemic period, because this whole period has really been one important market cycle. And critically, what you see here is that overall REIT returns versus the beginning of February 2020 are up almost 21%. So REITs, despite having exposure to some of the hardest hit sectors of the commercial real estate space, including retail and hotels, have recovered dramatically. And that recovery has not just been in stock performance. We've seen a recovery in capital markets performance. REITs have raised over $100 billion in 2021, about half of that in debt, half of that in equity, and we've seen a strong merger and acquisition market. So we've seen a strong recovery, and that recovery was really built on a set of factors that actually came out of going back to the financial crisis. Much like today's housing market is in some ways in stronger position and more resilient because of some of the changes after the financial crisis. Same is true with REITs. They came into the crisis with much more lower leverage, better structure to the debt that they did have on hand, and access to cash and liquidity on the balance sheet. So during the dark days of March and April of 2020, they actually were able to get through that period without distressed equity issuances or distressed buyouts or anything of that nature, and set the stage for the recovery we've seen in 2021. So I want to go through a couple of the sectors because I think the sector performance has really sort of been the most interesting factor. So I'm going to first highlight a couple of the sectors that have the strongest performance. And here we have industrial, data centers, and infrastructure. And infrastructure, just in our nomenclature, is cell phone towers. About 98% of the market cap in that sector is cell phone towers. So this is the digital economy in real estate terms. These are the logistics facilities that are delivering your goods you order online, the data centers that process that are holding the service processing the orders, and then the cell phone towers that's picking up the signal from your mobile device. And this is a very important part of the real estate world today. I'll show you the slide in a little bit, but today these three sectors account for 40% of the market capitalization of the REIT index. They're an incredibly important part of the world, the real estate world, and importantly, they're a part of the real estate world that are actually easiest to access through REITs. It's very hard to get access through private structures to cell phone towers and data centers. In fact, we've had some take private activity this year where private funds have acquired publicly listed data center REITs at very high premiums to their stock price because of the desire to get into this sector. So let's talk about some of the sort of surprises, I think. And the biggest surprise for this period has been self-storage. So with overall returns of over 70% over this entire COVID period. And this, I think, is a great example of how sometimes our imagination fails us because and consumers are always sort of a step ahead of analysts, I think. Back in February and March of 2020, it was very clear that retail and hotels were going to be hard hit by COVID. What we didn't understand as analysts was that we were going to have this follow-on effect where people staying at home, clearing out the guest bedroom, clearing out the garage to make a home gym, clearing out the basement to be the second or third office or the schoolroom, we're going to drive a tremendous amount of demand into the self-storage space, which is what we've seen over the last couple of years. That, coupled with some of the graphs you saw on home sales, which is a traditional driver of use of self-storage, has created a tremendous amount of energy in the self-storage space. The other piece I'll note is residential, which at the beginning of the crisis, we saw a residential sell-off. There was a concern that multifamily was really going to suffer. People weren't going to want to live in apartments in central business districts. And really that turned out to be unfounded. What we've seen is that people have returned to we saw some rent declines at the beginning of the crisis, but overall we've seen that people have returned to the central business districts. People want downtown living, even if they don't want to go to the office. And as I think we'll probably talk about, we have a dramatic housing shortage in America, somewhere around 5 million units. And just like single family rentals and single family home sales have benefited from that, multifamily and the residential portion of the REIT market market have been beneficiaries. And then I just turned to two of the sectors that have performed the worst. I think is important to note. It's office and lodging and resorts. And of course, lodging and resorts, we could see it in the occupancy rates. We had revenue per available room. At some points was down almost 90% in the depths of the crisis. Still hasn't fully recovered. Office is, of course, very interesting because office rents have been paid. We have had very little diminution. This is really investors pricing in the forward risk of what is the impact of work from home going to be. I'll also note here that I didn't highlight it. Interestingly, retail is up almost 10% over this entire period, despite having a very tough beginning. Retail, and especially malls, has had a dramatic recovery since the announcement of the vaccines back on November 8th, November 9th of 2020. The mall sector is up almost 80%. So we've seen a dramatic recovery in retail, and it's not just in the stock performance, the operating performance is up too. Foot traffic is up, and we're really seeing a rebound in the retail space. Although, of course, it's lagging the broader index. So just to touch briefly on a couple of our big questions, office and work from home. This is the single biggest question in commercial real estate right now, and the question that is really going to matter is not so much when do we get back to the office in terms of a date certain. The question that is going to matter is when we get back to the office and we integrate the new ways of working that we've learned, because I do believe the offices will remain the center of the work life for the vast majority of Americans. But the question is, as we're seeing people work from home a day or 2 days or 3 days a week, or having part of the team that is not co-located with the main team, what is that ultimate impact going to be on square footage demanded? And I think it has to be negative. The question is how negative. And I personally am fairly optimistic because I think that over the next 3 years, we're going to see organizations experiment with a lot of different ways of housing their workforces and organizing themselves. But ultimately, I think they're going to find that the importance of being in person and having your team together for building culture, for innovation, for actually having human understanding is going to be paramount. And I think in some ways, I think we've been on a little bit of a sugar high over the last 2 years in terms of productivity away from the office, because we're running off of capital we built by working with our colleagues in person for years and years and years. Certainly in my organization, we have people who have worked together for 20 years. I've been there for over 5 years. We know each other. We trust each other. We can communicate. Remotely. But I don't know that we're deepening and building those relationships, and that's what being together brings you. Retail, as I mentioned, a big question. We saw a burst in online shopping in the middle of the COVID period. That has been coming back to trend. Importantly, what we've actually seen is as in-person shopping has come back, online shopping has also continued to grow. So we're seeing consumers adopt what my colleague Calvin Schnurr writes in our Outlook piece, a more of both approach. And I think that's likely to be the way going forward. And finally, digitization of the work, shopping, and leisure, it's absolutely here to stay. And I'm going to just show you a couple of graphs. I'm going to briefly talk about the inflation outlook before I jump into that. I want to be cognizant of time. I think inflation is going to dissipate in the next 12 to 16 months. I don't think we're going into a price wage spiral. When you look at 3 months annualized inflation rates versus 12 months, you see that a lot of the inflation we're seeing in CPI is baked into the reports because of the sharp increases in prices that we had back in the spring due to supply chain issues. Importantly, much like Lawrence is making the point about single-family home ownership, REITs, commercial real estate provide meaningful inflation protection. As you can see, when we go back through the data, we find that REITs outperform the broader stock market in periods of moderate and high inflation, looking back through the data. And importantly, that is driven by operating performance. So we see same-store net operating income, the actual income that's being generated by the properties, outpaces CPI during periods of moderate and growing inflation. Okay, I'm going to go quickly through two emerging themes that I think are important to keep our eye on over this year and forward. The first is, I mentioned the 21st real estate portfolio, the changing face of real estate. Real estate is fundamental purpose is to house economic activity, house our lives, house our economic activity. It has to change with our economy, and it is changing. So I mentioned earlier, industrial and logistics, data centers, cell phone towers. Today, if we look at the index of REITs, today these are 40% of the index. So they're very, very important parts of our real estate space, and they're parts that investors are accessing through the REIT market. Last item I'll just talk about, I'm going to jump over here, is sustainability. I think that we've seen REITs embracing ESG. This is going to be part of environment, social governance. This is going to be part of the conversation in commercial real estate going forward. And we're moving into a place where we're moving past ESG into ESG plus wellness, and all of that is going to shape the investment universe for commercial real estate going forward. With that, I know we're anxious to get to questions, so let me hand over the clicker, and we'll get to your questions. Thanks.
All right, thank you. Lots of stuff to unpack here. I was going to ask questions, but we got 5 minutes, so I want to make sure I give people a chance to ask questions. Yes, sir.
Lawrence, I've written the Bulk Property Journal. Given the fact that we're in Miami, Florida, are the international buyers coming back yet? And if they are, what's the forecast for 2022 on the U.S. housing market?
So the international buying activity plunged to the lowest in the COVID period. Now the international travel is open. Of course, Omicron virus has put a little twist to that, but it's really about the actual travel, because residential is something that people want to live, they want to feel it. For commercial, it's not important. It's about rate of return, cap rates. So the international travel is important, and given that now that the gates are partially open and maybe with the virus out of the way to some degree in 2022, I think there's a real pent-up demand on international buying activity. So we could not only see a recovery, but it could be quite a sharp jump upward in international buying, but all virus dependent.
Yes, sir.
On your pie chart, you showed, infrastructure data, all those things rising. It looked like residential was shrinking, and then you guys are saying affordability is getting a problem. More people are becoming renters than owners. So who is owning that property? It's a smaller share of the REIT universe, and it's a smaller share of the owner-occupied universe.
Well, let me just, so residential has shrunk proportionately over time, but it has grown in absolute terms in terms of sort of the market cap of the REIT indexes. And what you're seeing there in residential or multifamily on my pie chart, that is the vast majority of that is multifamily, is apartment residences. It includes some single-family rentals, some manufactured housing, but the vast majority of it is apartment rentals.
We've seen an increase in single-family investor participation in the single-family market in 2021. So in 2020, we actually saw a drop in single-family investor acquisitions of single-family rental homes. I think partly that was because of all of the economic uncertainty when the pandemic began, and the fact that there were moratoriums on tenant evictions. But now that we're in 2021, especially in the spring and summer, we saw a pickup in single-family investor activity. And when we look at the CoreLogic public records data, we were finding that about 1 in 5 homes during the summer were purchased by single-family investors. So it's a significant component of the marketplace here in the last few months.
Yes.
And who are those investors? I mean, if they're not REITs, they're individuals? Are they private equity? Or
most of the rental properties are just the mom and pop. In fact, realtors. We believe that about 1/3 of our members own an investment property. So they're owning, one or two property for supplementing their potential retirement income. Alex Rodriguez, the New York Yankees baseball player, he grew up in Miami. We had him in one of our conferences. He has a lot of money. What is he doing? He said he's going to buy single-family rentals. He's looking at all the metrics, and he said rents are rising, and he and his partners are buying single-family rentals. So these are pure investment. I don't know whether to categorize as private equity, but he's raising funds. He's using his money, and he said he's principally going into southeastern states, everything from Texas, Florida, to Carolinas, as to where he wants to aggressively purchase single-family rentals.
John, you mentioned there's been a lot of activity this year in private funds taking data center REITs private. I'm curious, looking ahead to next year, what sector do you see as the most prime for that type of take private activity? Either because there's a lot of private investor demand or their stock prices are viewed as discounted relative to their net asset value.
Well, I think one of the keys I'd note is that when we look at M&A activity in 2021, there's been a lot of attention paid to the take private activity. Even though one of the data centers, it's important to note, was was acquired by one of the cell phone tower REITs, and then the other two deals were more or less take private. The important thing not to lose sight of is that the majority of deals this year were actually REIT to REIT deals. So we saw in retail, in particular, we saw REIT to REIT deals of actually REITs lowering their cost of capital, getting bigger, and preparing for growth. So I think we're going to see more M&A activity in the forecast, but I can't tell you whether that's going to be take private activity or REIT to REIT activity, because they're both really vibrant markets. And then in terms of sort of where properties are trading at discounts to their NAVs, of course, office really jumps out. I mean, the share prices are down versus pre-COVID. There's cases where they're trading at a discount to their net asset value. That's sort of their assumed private value. So that always raises the prospect of is there M&A, is there acquisition activity in those markets? But I wouldn't discount REIT to REIT activity. There's a lot of activity there in addition to a little bit of take private activity. And then the key really, I think, in the mergers space for 2021 and 2020, I think, is sort of the dog that didn't bark, right? We didn't have the distressed mergers and acquisitions that many people thought we might have early in 2020. What we saw were actually mergers of strength to build for growth, which I think, again, that kind of goes back to this concept of the resilience of the market.
All right, any more questions? Probably have time for one more. Yes, Aldo.
Quick one. How much forward buying has occurred during this spurt? I mean, can we take it from future demand in any sense?
It's really the magical power of mortgage rates. I think there is always that subconscious desire to own. And when the mortgage rate plunged post-COVID, people said, wow, I can now own a home. And furthermore, they could buy in the next county where things are more affordable because commuting is less important. Now, is that buying forward? So I think, some of it is always the case when there's a surge that people who may have bought, say, 2 years from now, rather they just bought it just last month. So I think there's a little bit of the movement of the forward demand upwards, but it's really the impact of mortgage rates. So if the mortgage rate sharply rises, surprisingly, say inflation becomes stubborn, forces Fed to raise interest rate, you could really have a meaningful decline in home sales. While if the mortgage rate remains steady at the current level, it's really about the job growth. So jobs generates, so that can continue to boost demand.